OK, let's move on. 10 leading investment professionals have joined together to question whether the market is investing on fundamentals with a view to combating irrational and dangerous market behaviour. Joining us now is Saker Nusseibeh, who is the chairman of the 300 Club. Very nice to see you, Saker. Just tell us exactly what you're talking about here. You're bemoaning market practice.
We are. There are 10 of us. I am by far the least important of them. Preeminent and leading investor figures. And what we came to see is that collectively we know that a lot of the so-called theory that people use to invest is overcomplicated, is either misunderstood, misapplied or plain wrong. There's too much complexity in the way that people invest, and actually that has, in our view, been part of the reason that has led up to the crash of 2008 and part of the reason why we are where we are now. The investors, the investor pool, if you like, through the pension funds and through other saving vehicles, control a lot of the supply of investment that goes into the marketplace. They're advised by professionals who seem to have taken presumptions, turned these presumptions into what they believe is science, applied them incorrectly, and then we're surprised at the volatility they've resulted. So it's quite a wide topic, and it's us saying to people, look, let's just question the very fundamentals of the so-called investment theory that you use. Let's remember that it's based on presumptions.
Saker, are you basically saying the regulators are fools and don't understand what on earth they're trying to regulate? Because let's face it, they're the people you should be petitioning, aren't they, about this?
Not at all. We think it was well put by one of our members, William de Wilde, who's the CIO of BNP, and he also is a lecturer at Ghent. I mean, I think a very sound academic person. He said, look, each individual person in their individual bit is acting rationally. The problem is, if you aggregate the totality, it's irrational. Let's go to the regulators as an example. It is right and proper that the regulator should say that they want to reduce risk. That is correct. It is right and proper that the regulator should try to influence, for example, pension schemes to reduce risk. That is good. One then questions, all right, we accept that principle. Is it right and proper to use value-at-risk models? In our view, value-at-risk models are good for what they were designed for, which is telling you how much a trading book for JP Morgan might lose in any one day, assuming no major market move, but it's not the right thing to have if you apply to a pension scheme. That sort of thing.
Gentlemen.
I'm still a little puzzled, to be honest. I mean, this is like a hostage situation where the hostage is holding the gun to his own head and said, if you don't free me, I'm taking my head off. You are in and of the industry, and yet you seem to be criticising the industry, but I can't work out why. What you think the end game of that is. Why are you trying to head off further regulation at this point by demonstrating that you as an industry can self-regulate?
An interesting question, but actually it's not how we've come about it. And you're absolutely right. We're from the industry. The industry over the last 20 years have gone down the path, which, as I say, is well-intentioned, but is actually going the wrong place. We as individuals, not as representatives of our institutions, and this is very important, we as individuals have been talking to each other. And it seems to us that a lot of things that we take for granted, that we accept amongst each other, we never quite say publicly, because the industry is gone to a place now where it sells products to people rather than gives true advice. So all that we're saying is, look, let's share with you, everybody, what we individually know to be true, let's question it, and by doing so, I accept that actually we put ourselves individually, as in our career sense, and as an industry in risk. But it's right that we should do so, because this is not about the industry or us. Actually, this is about society. I mean, it hits savers, and as Andrew, who's sitting next to me, would tell you, it also hits wider society, because it's about the application of risk capital to society. This is a big question. Andrew.
Yes, one of the problems you're trying to address is something that I think has grown up over the period of the financial crisis, that people see these very extreme events happening in financial markets, a great deal of volatility, and find it very hard to connect that with what actually investments are meant to do, to provide pensions, to provide a home for their savings. So are you trying to reconnect what you're doing, which should be long-term investment, with public perceptions of what your industry should be doing?
Absolutely. And what we're saying is, you know, let's take a step back and let's look at the way that money is invested. Let's look at the theory that has been used to invest money. And let's do two things. The first one is, let's have an open debate about its basis. The second one is, let's question this extreme complexity that has entered over the last 10 years, say, but particularly the last 5 years. Complex instruments, complex models, which have led people who control investments through good intentions to feel that somehow they understand the risk, and also that they feel that there is something that's a free lunch, a risk without return. It doesn't work that way. Return does equate to risk, and complexity for its own sake is not good.
Is there more that pension funds could do themselves? Because they have got involved in, for example, some pension funds have allocated money to hedge funds and other complex instruments. Should they be getting back to bread and butter investment and just holding a much more simple portfolio of assets?
I think that could be an answer. I think the first thing is, let's understand what it is that they're investing in and whether they are happy with the complexity and whether the returns truly are commensurate with the risk they take. That's the first question. They should then let us all collectively differentiate between risk and uncertainty. As Keynes said, as you well know, you can, but you can't measure uncertainty, and what's hitting us now is uncertainty. And let's get away from this feeling that if we have this complicated pseudoscience, which is what a lot of these instruments are, we will actually somehow get a better return with lesser risk than we would otherwise. It's just, I mean, you know better than I do, it's economically nonsense.
So Saker, is this the industry belatedly getting a conscience? That for years we've been ripping off the poor old punter, selling them dodgy products that have quite frankly lost them money while we've been taking fat fees, and finally we need to start getting in touch with ourselves and telling the community that actually we understand that the financial industry should be here for a different purpose, to service the real economy, not actually to put money into the pockets of fund managers and fund management companies.
I think I'm
sort of being glib, but you understand the point here.
I think the point is this. As I said to you at the beginning, I think each person in this sequence has behaved to the best of their intentions. The problem is that the end result has not been to the good of all. And I'll give you specific examples. When I started in the city 25 years ago, there was a sort of fiduciary responsibility of the asset managers with a small f between them and their end clients. Over 20 years, that has broken down, whereby essentially fund managers are sort of factories that provide products. They sell them via the consultants or otherwise to pension schemes, and it's buyer beware, caveat emptor. That has to change. We have to go back to talking to each other. Some fund managers and some investment banks have come with very complicated models and said, well, look, this is really based on science. It's like physics, really. And if we apply this methodology, you're going to win without risk. That is not true. What we're saying is, let's open dialogue. Number one, let's have transparency. And number two, let's move back from complexity.
Just looking down the list of your participants, I noticed that one of them, and as you say, surprising who's on this. So one of them is Dylan Grice of Société Générale. So I just tapped into my various search engines. I use all kinds of browsers. Société Générale Algorithmic. And there we go on execution services at the corporate investment banking group of Société Générale, program trading and algorithmic trading. So I would suggest to you that while some parts are paying lip service to what you're doing, actually they're just carrying on very merrily with their algo trading, which I guess is part of the problem that you're saying that we need to get back to fundamentals and away from this kind of stuff.
I agree. I mean, two things. One is Dylan is there, and each one of us is there in our personal capacity. Again, you know what we do. We have stood up because we think it's right and proper to stand up, even though our institutions, we're not representing our institutions in this. Right. If you listen to Dylan, actually, Dylan is one of the most powerful and I think amusing critics of using complex systems. And I would urge you to have him on your program. He's very good when he talks about this.
We'd love to do that. Dylan, please, come on, get in touch and we'll get you on tomorrow. I'm sure we'll find a space. We've got a few redundant guests. Right, gentlemen, lovely. Just one thing, Saker, the 300 Club.
They got
this is a reference to Thermopylae in 480 BC, isn't it? Yes. Where Leonidas and the Spartan 300 got slaughtered, didn't they?
Yes. I think.
Do you expect to get slaughtered?
Well, I'm beginning to get slaughtered already. I think the reason we chose it is what were they? There were 300 men who decided to do something which they believed was right for the good of society as a whole, even though they knew that they by themselves couldn't change the tide. All they could do is buy time for others to turn the tide. So maybe we can do that.
Do you know that I have a lot in common with the Spartans, you know?
Do you?
Yes, because they're very laconic. If. It's probably the best quote ever, isn't it? Right, thank you, Sam.